Hey traders, Raghee here. Happy Thursday, everyone. Welcome to Charts and Huge Mugs of Coffee. As always, great to have you here. Thanks for being here. Hope you're having a good Thursday morning so far. A lot of volatility hitting the market with the CPI number. So let's go ahead and head on over to our calendar. Just a quick reminder of the hot zones that we have today. Not many, not many for the 11th, but you'll notice we do have the PPI. And if you notice the 8:30 volatility that we saw, and let's go to the 5-minute chart. I'll just take you to the S&P here. The 8:30 volatility, that's that candle right there. It's really interesting because there'll be a lot made of the post, and let me get the drawing tools here. There's likely to be made a lot of the post PPI result, but frankly, that's not a massive candle. And we were already heading higher, as we still are, by the way. And 745, the uptrend organized and was visible. So really the PPI is just extending that move. This is the S&P. You can see the same thing on the NAS, right? In fact, the NASDAQ up organized, excuse me, organized a little bit later than the S&P. You'll notice it's about 8 o'clock, 8:05. And the Dow, there we go. And the Dow, well, this thing's been heading higher since before 7 a.m. So Dow already organized bullish. S&P followed about, an hour or so later, and then the NAS was the last to catch up. This is an uptrend, and the PPI was not the cause of it. It really wasn't the cause of it. It's allowed it to keep going. So really nothing changing in terms of what that 8:30 hot zone did. Know your hot zones, gang. Know when those scheduled high impact, high volatility releases are coming. And you'll notice that overall, we continue to march higher, right? I guess we're waiting for that recession crash to come. Overall, we're heading higher within the doldrums of summer. And we're still in those first 2 weeks of August where this is really the most concentrated look at any kind of summer trading behavior. But nonetheless, we can see that little by little, again, I use moving averages to be able to have a consistent way to measure whether or not a market's in an uptrend rather than, oh, look at that big candle, right? Which is frankly what most traders reduce market moves to. They look at a big candle, and a big candle is the reason for bullishness, which sometimes those reasons will overlap, but that's seldom going to be a consistent or process-driven way to do it. So whatever your preferred tools are, right? I just happen to use moving averages, but if you like an MACD or if you like some other tool, awesome. Make that systematized, right? Have a way in which if this happens and this happens and this happens, it's an uptrend. And if this happens and this happens, the trend is broken. And, have those criteria. It's going to make life so much easier. But this is what we're getting this morning. Last place I'm going to stop before we jump into the questions is, of course, where I'm going to head on over to. Where does that data land? And is it really significant? It's not significant in any way. Not at all. Now, it's easy to look at September. The way we get to December is almost irrelevant at this point, right? It might be from a volatility, shorter term trading standpoint. But if we're talking about the giant tectonic plates of the macro rate of change, right? As we talked about, and I don't know that I have that chart that I shared with you all handy, but if I do, let me bring it up. It was a great image of, do I not have it? It was such a great image. It was a great image of M2. Oh, here it is. Here it is. This is great. This is Bureau of Labor Statistics and the Federal Reserve Take a look at this. When M2, that's money supply, starts to drop, that's the cyan colored line, inflation follows. That's, I'm not going to say there's not that many leading indicators in a market, but when it comes to money supply and inflation, we know that inflation, because of the increased money supply, right? There's your causation. And when that money supply contracts, inflation should head down. And that's kind of basics economic 101, right? And so that's where we are right now, which is very cool. September, whether we raise half a point, hold 3/4 of a point, does not matter. What matters is whether or not by year's end, we are still factoring in either a target rate peak of 3.5 to 3.75%, or the slightly less hawkish 3.25 to 3.5. And you'll see that's exactly what's back in focus, courtesy, any number of data points, and in many ways, probably most recently impacted by the PPI. This is where we sit. Are we sitting anywhere new? No. Can the market keep moving higher? Why not? Right? We're still moving mostly to the right, and we're still favoring mostly that target rate probability that we've been expecting. It's been discounted. It's already priced in since really the beginning of the year, which is at 3.5 to 3.75 column. That's it, gang. There's your macro nugget right there. That's how simple it can be. All right, so let's jump on into the questions, gang. All right, first up is now that the slow stow is no longer valid because we're in a trend, and not just a slow stow, Christian, great point. Any oscillator. Oscillators are great for oscillating markets. It's a disconnect that I see in analysis all the time, which I find very unusual, but great observation. Absolutely. What tools be considered valid to identify possible pullbacks? Darvis is great. Fibonacci retracements are great. Yeah, absolutely. I like the wave or propulsion. Those are the tools that I'll typically focus on. So wave and propulsion are my preferences. One of the things that we did yesterday, so on Wednesdays, I do a session where we'd have a really dedicated watch list building hour. And it was following up on this hour. So we kind of carried that conversation through. We built the watch list here. We started setting alerts here during the session. So alerts to when we know we want to be aware of price reaching a level at which is a trigger for our entry zone, right? So to your question, Christian, now that I know that I want to look at the wave and the propulsion within the context of a trend, you're spot on. Now we want to start placing alerts on our charting platforms, not for trades, but I call it, there's trade alerts that we send out. And then I like to set up a proximity alert, which is exactly what it sounds like. When is price getting close to a level that I need to make a decision near, right? In other words, as it gets closer and closer, that decision becomes more and more imminent for that trade setup. So I never use price action only. I know some people are big fans of naked charts, which is fine. I'm a fan of just a different visual footprint, so what I'll do is I'll use the propulsion, which is a different way of looking at exponential moving averages. And I'll look at my wave, which is a trio of exponential moving averages. So that's usually in a trend. Christian, that's my jam. So that's what I prefer. All right, next up, can we take a look at CVS? Absolutely. CVS has just turned into an uptrend. Buy the dip would be valid. That is true. And that's really what I need. I need a move to the downside. Gang, there are traders who love the movement higher, and with the movement higher, they buy. Nothing wrong with that. It's just never going to be me. That is a momentum trading approach. That's looking at the way in which bullishness is punching up to higher highs and higher highs. And that's one style. It's just not a style that I use. So I need a pullback. Jose, that off mentioned, often mocked buy the dip. I'm a buy the dipper. It just works. The reason it's mocked is most people don't understand, A, what a dip is, right? Which is simply a retracement, or, the popularly phrased regression or reversion to the mean. But it has to be done in a trend. And the more clear and established a trend is, the clearer that dominant psychology to the up or down side is. So that's what I do. What's my favorite scan for finding pullbacks? That's it. I'm very old school. I'm not a fan of scanners. I don't use them. Really never have. I like to go through the charts. So JR, you need a curated list of names with a good correlation to one another. That's what I start with. And that keeps my pool of names not only connected, so I don't have disparate stocks sort of just doing their own thing because they're a meme stock, which I do not trade. And then I just look at the chart, and it's ridiculously old school, but I love old school because I am old school. I started trading pre-internet, when charts were mailed to my home, and I'd have to sit with pen and ruler and calculator and mark these up and calculate my own indicators if I was going to use them at all. So my favorite scan is looking at the charts and having a well-curated list to recognize the environment where the pullback is valid, and then place those proximity alerts for where they are most likely to give me a buy the dip opportunity. So thank you, JR, for the question. All right. ES, in terms of the daily, sure. We have a double green. We have the 21 green propulsion dots. I can be a buyer at the 21 EMA, Nancy. Yeah. But remember, if we're looking at ES, XLK, XLF, XLV are also possibly in play. And then think about all those correlated stocks within those sectors. So index, sector, stock, it's going to give us a lot of opportunity to find the best relative outperformers to the upside. All right, next up, when scanning for intraday plays, what basic criteria do I look for? Robert, I'm always going to prioritize trends. I like to find a trend. When we don't have a trend, the next criteria is, and I'm only looking at about maybe, let's see, 1, 2, 3, 4, 5, 6. I'm only looking at maybe 8 to 9 symbols for day trading for my futures. And I'll always start with futures, because if I have clarity on the S&P, NASDAQ, or Dow, that can then filter into clarity on the XLK, XLF, XLV, XLC, XLY, IYT, XLI, right? So we know there's a composition of sectors weighted within those indices, index sector. And then once I have clarity at the sector level, then I can find the relative outperformers at the stock level. But I'll always start with Dow, crude, S&P, NASDAQ, gold, notes, bonds. I'll look at the VIX. I'll look at the euro. That's really it. And then I can start to filter down if I want to get more granular about maybe a sector ETF day trade or a stock option, right? I can play with ETF options or stock options. So when I'm day trading, by the way, when we're doing, and by the way, we do day trading every morning. So I love the question. Thank you, Robert. What we do in the morning is we start scanning, right? Those broader futures indices or commodity charts. Then we'll filter down to the next opportunity. But the cool thing is about those futures contracts is minis, there's micros. If you don't trade futures, no worries. SPY options are incredibly liquid, very affordable, and leveraged. So when I'm day trading, it's going to be futures and or the options on the alternative. If I find that QQQ looks great, but XLK looks even better, right? Your sector that's highly representative of Apple and Microsoft, I might go that route. If consumer discretionary is having a great day, Amazon's on fire, or Tesla's on fire, or Home Depot, Visa, then I can go XLY. So if we start with that process that I'm explaining, it makes it a whole lot easier. So that's the plan. And by the way, when you talk about intraday, I'm glad you asked, and I'm glad that you all have interest in that. I have to mention this, gang. Time of day really matters. And this is something that I, as a young day trader in the mid to late 90s, I made these mistakes. And I'm hoping that you won't make these mistakes. First of all, the day isn't the day. The day really is broken up into about 4 pieces, right? So there's no such thing as a trade that I'm going to find on a regular basis early in the morning that's going to take me all through the whole day. Yesterday, we happened to have had an S&P trade that we set up in the morning, and it took us through the whole day. That's not normal. That's lower percentage. Before that S&P trade came along, by the way, I had a loss in crude, quick loss, paper cut, that way I described in the free video from Tuesday. And then even after that S&P trade was open, I had a quick small loss in bonds. I didn't want to take the trade, but it was bad on me. I didn't cancel my limit order, right? I'm going to overlook things, right? I think it's really important for me on this side of the camera and the mic to say, look, there's going to be losses and I'm going to overlook things, right? But does everyone remember what the S&P did yesterday? We had a trade. We entered at about, I'm trying to remember what time that was. But hey, Bot, hey, Bot, are you listening out there? What was my trade on the S&P yesterday that we took in the mastery? It was a good day. I mean, I was just in it all day because it just trended and never stopped us out. We scaled out, moved to break even, and then we just trailed it out until finally I had to get out because of time. I had to get out because of, hang on, Bot's giving me an answer here. Everyone needs a bot. Yeah, right around 10. I got in right around 10 a.m. Eastern, and I got out at about 3:50 p.m. because I was running out of daylight, quite literally. So I've got to be flat by the end of the day. So I like to get out by about 10 minutes to 4 p.m. That's not normal. What is normal is you're going to have a pre-market psychology, like what we're looking at right now. You're going to have a morning psychology. You want to avoid the midday doldrums. You're going to have a PM psychology. You really have 4 days every day. So this idea of day trading and taking something all day long is really not true. And so yesterday was one of the rare exceptions where we were able to do that. So remember today when you're trading, is this the morning psychology that I'm trading? Is it a pre-market psychology that I'm trading? Am I avoiding the midday doldrums, or at very least, like I did yesterday with the S&P, managing this winner, not smothering it, but not giving back too much unrealized profit based on the volatility of that time of day? And then is that psychology continuing into the afternoon session, which sometimes this AM session can look absolutely like a different day compared to the PM session. So please keep that in mind. You're really dealing with 4 different phases of a day. And I think a lot of traders think, well, I could put in a trade in the morning and set it and forget it. This isn't Ron Popeil, right? So please remember, that was a really important lesson, I think, for a lot of traders, where they realize, oh, wrong, there's a cutoff. Absolutely. And many of you saw my bond trade, which was one of the 2 losers that I had yesterday. S&P more than made up, but I went 1 for 3 yesterday. Still a great day, but I went 1 for 3. And a lot of you realize, hey, Raghee, if we would have used that cutoff, we never would have gotten into the bond trade. And if we would have used our line in the sand, we never would have gotten into crude oil. That is true. I took them anyway. But I really want traders to see, which boxes are you checking for your trades? And then where does that map to? And the more boxes you can check, the fewer trades you will take, and usually the better the follow through and probability. So scanning, Robert, I know, what a huge answer, but scanning really is the process of thinking about all that. And I hope you all don't mind the quick little day trading workshop there, but we've been slaying it. And partly the reason is that cutoff and respecting the different phases of a single US trading session, right? So what are my thoughts on gold and bonds? Gold and bonds are going to be in play in a huge way because of the shift we're seeing in terms of psychology of the rates, right? Gold is not in a trend yet, but I do see the downtrend is broken. We're still sitting below the 200. So not quite ready for an uptrend, not quite ready for prime time there. Bonds are probably a little bit further along, but they too are still stuck in a range. They too are still stuck in a range. And Bot says we got in at 10:30. That sounds about right. Okay, so that trade was around 10:30, was it? Okay, I thought it was a little bit earlier than that. I think you're right, around 10. Bot, yeah. We took that S&P trade around 9:45 or 10. Okay, so not quite yet for trends. They're kind of sitting at overbought resistance, right? Overbought resistance is what I would say. Why is a December interest rate important and not next year? Because the logic usually is, where are we ending the year? That's first. And Sue, the other reason December is so important is that's the peak. And you'll notice after December, we're not seeing, and I will check to make sure that's still correct, but after we peak in December, we're not seeing as we go further out, anything really higher than 3.5 to 3 3/4. So sometimes we were showing signs of maybe peaking in November, but we're not. We're not peaking in November. We're peaking in December, and then it levels off. So it's what month do we peak and then plateau? It just happens to be also the end of the year. All right, gang, I'm running over here. So thank you as always. Thank you as always for coming in for our Charts and Coffee pregame show. Caffeinate and dominate, gang. Be good to each other. I'll see you tomorrow.